Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I am going to walk you through the process of valuing Royal Caribbean stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Royal Caribbean Group is a cruise holding company based in Miami, Florida. It is the world's second largest cruise line operator after Carnival. It owns 3 cruise lines: Royal Caribbean International, Celebrity Cruises, and Silver Sea Cruises. They also hold a 50% stake in TUI Cruises. Let's get started with the model. This is a large cap company, 16 billion market cap. They're trading at $66 a share, and they have 237 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So the company has positive free cash flow in 2 of the 4 years, a big negative in the trailing 12 months. Net income is the profit and loss on the income statement. It's revenue minus expenses. They did have positive until 2020 when COVID happened and the cruise lines got slaughtered. Revenue is the sales for the company, and that was growing nicely from 2017 to 2019, but was more than cut in half in the trailing 12 months. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Then the difference between those two numbers is their gross profit, and that was really low in the trailing 12 months, much higher in prior years. Below that is operating expenses, and they did have negative operating income in 2020. They had a positive $2 billion in 2019 and close to $2 billion in 2018 and 2017. The company has over $600 million of interest on their debt. Then there's other income and expenses. The company passed through a large asset impairment in the trailing 12 months, which brings down their net income even more. An asset impairment is when you reduce the value of an asset on your balance sheet, then pass through the loss onto your income statement. So it brings down your net income, but it doesn't affect cash flow. So in the trailing 12 months, they had a big negative $4.2 billion. But in prior years, they were generating positive net income. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. Then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. Free cash flow is the cash that's left over to grow the business, to pay a dividend, to pay down debt. And this company does not have much free cash flow, except in 2017, they had over $2 billion. The company took out a lot of debt in the trailing 12 months, $26 billion, because they were operating with negative free cash flow, so they needed cash to run their business. The most important part of any business is their operating cash flow. This tells you how much cash the company generates from its operational business. And they lost $2.3 billion in the trailing 12 months, but they had over $3 billion in 2019 and 18, and almost $3 billion in 2017. The way you calculate operating cash flow, you start with net income that was negative $4 billion. Then you add back the depreciation. That's a non-cash expense that brings down your net income, but you have to add it back on the cash flow from operations section. There's also $55 million in stock-based compensation. Then there's also a $1.4 billion asset impairment. So all cruise lines are losing money because they're not doing much business due to COVID. Things may turn around in 2021, but we're not sure when. Let's look at a capital structure: $12 billion of equity and $12 billion of debt. So they're 51% equity, 49% debt. And their WACC is 17%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $16 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $11 billion. We divide that by 237 million shares. And we get a calculated stock price of $46. They're trading at $66, so they're trading at a 45% premium. It's a sell according to the model. Simply Wall Street values the company at 175, so they're saying it's undervalued. They're in a totally different direction as me. So it appears that they're expecting their free cash flows to really grow in the future, not as much as me. I don't think my model was too conservative. I'm expecting them to have negative free cash flow in 2021, then positive in 2022, then growing a bit the next 2 years. You can see the stock was trading about $120 before the pandemic. Then it crashed really low, and it's pretty much doubled since the bottom, but it's still well below its all-time highs. This company has a really high beta. It's almost 3, so the stock moves 3 times the market. It's a very volatile stock. The stock has gone down 45% in the past 52 weeks, much worse than the S&P 500. The low for RCL is 19, the high is 122. And the stock is trading above its 200-day moving average, but below its 50-day moving average. About 4 to 6 million shares are traded each day for this stock. And of the 237 million shares outstanding, 204 million are on float. 61% of the shares are held by institutions, and almost 6% of the shares on float are shorted. If you invested $10,000 into this company 10 years ago, you could have sold for over $30,000 before the pandemic. But if you're still holding, you're at $17,000. Not a terrible return on investment, about 5.5% per year. Capital Research owns 10% of the stock, then Vanguard 8%, then A. Will Helmanson owns 7.5%, then BlackRock, then Canada Pension Plan. Let's look at the financial ratios. The average PE in the market's 11.3, the median is 14.4. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so they have negative PE. Price of sales is stock price over sales per share. They're at 3.3. They have a pretty good price to sales ratio. Price to book is stock price over book value per share. They're at 1.3. They have a really good price to book ratio. And the way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities in the balance sheet, and they have $12 billion of equity, $10 billion of tangible equity, because they have $1.4 billion of goodwill and $500 million of other intangibles on their balance sheet. Interest coverage ratio is EBIT over interest expense. They have negative EBIT, so they have negative interest coverage ratio. ROE is net income over equity. They have negative net income, so they have negative ROE. Current ratio is current assets over current liabilities. They can only cover 10% of their current liabilities with their current assets. That's a really bad current ratio. And the company is not well capitalized. They're going to need more debt to run their business over the next 12 months because they had negative free cash flow and they have negative $6.8 billion of working capital. The best way to look at ratios to compare them to similar companies, I've done videos on Booking Holdings, Carnival, Expedia, Norwegian, TripAdvisor, and TUI, all in the same industry as RCL. And if RCL has a number in green, they're better than the average. If they have a number in red, they're worse than the average. So they're worse in PE, they're negative like most companies in this industry. They're a little worse in price of sales at 3.3, the average is 3.1. They do have a better price to book than the average company. They're doing terrible in current ratio. I think this is the worst current ratio I ever seen. Terrible ROE. They're a little higher in debt than the average. They are smaller than average in market cap. They stopped paying a dividend last year. So to summarize, I have them trading at a 45% premium. But that doesn't mean their stock price cannot go up. It's how investors perceive the company's future. I rank their free cash flows 1 out of 10. They weren't too high in 2019, and they're a huge negative in the trailing 12 months. I rank their revenue 3 out of 10 because they were growing from 2017 to 2019. Of course, it's really low in the trailing 12 months, but that's due to COVID. I rank their ratios 3 out of 10. They have pretty weak ratios. A lot depends on how long it takes COVID to go away, how comfortable people feel traveling, and how comfortable people feel on going back on cruise liners. I don't think this is a dead industry. I just think it may take some time to fully come back to where it was. It could be another year. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.